The biggest question that everyone should have today is what the heck went on in the bond markets, thus the interest rate markets in Canada today after the Bank of Canada announcement that was really a non-event. We thought that they weren't going to change rates and they didn't. So why did bond markets really take off? Let's look at some of the data and some of the charts. Let's talk about what's going on in Canada, what's going on in the States, and what really matters if you're planning on buying real estate in Alberta this year. So let's start here. What really happened today? We had this announcement. All the mortgage brokers in town had this announcement. There was lots of conversation about, but Bank of Canada holds the overnight lending rate at 5%. But who cares? That's what we expected. That's exactly what they did. So what happened? Our announcement really shouldn't have mattered at all. But what did matter today? We saw our 5-year Government of Canada bond yield tick up 13 basis points today. That's the most we've seen in a really long time. Our bond yields is really what affects long-term interest rates, okay? That's what affects your 5-year, 1-year, 2-year, 3-year, 4-year interest rates, fixed rates on mortgages, okay? And so we saw that shoot up this morning right around the same time that the Government of Canada decided to hold the overnight lending rate at 5%. So why did that happen? US inflation. This is what happened. We saw a really high US inflation number, much higher than expected at 3.5%. So what did that do to 10-year Treasury yields? And now remember, 10-year Treasury yields really pull on that 5-year Government of Canada bond yield, okay? So we saw Treasury yields tick back up. They were up 17.5 basis points this morning. So when we had a market that should have been very sleepy today, we had an expected announcement, we had some spicy inflation data in the States, and that inflation data really took our bond yields with it today. So what the heck is actually going on in the States? Well, in Q4, their debt grew by $830 billion. But in Q4, their GDP only grew by about $334 billion. So what does that mean? It means that for each $1 in GDP growth that they're seeing, they are spending $2.5, $2.50 to get $1 of growth. That's hugely inflationary behavior and causing really spicy inflation data numbers in the States. That's going to continue to pull on US Treasury bonds, and that's going to continue to pull on Canada's 5-year Government of Canada bond yields. So what that means is that rate decreases from the Fed or from the Bank of Canada are likely to be pushed out quite a bit further. The super interesting thing when you look at this is that the debt to GDP ratio is actually higher than where it was after World War II. They are spending a ton of money. It's crazy inflationary behavior. We should be starting to see that move the other direction if they really want to start getting inflation under control in the States. In Canada, on the other hand, we are starting to see some signs of recession. We saw unemployment numbers start to tick up. We've seen credit card balances and credit card delinquencies start to tick up. We've started to see some mortgage delinquencies start to tick up, but it's just not enough for the government to actually start dropping rates. They're thinking that they may start with a small drop in June, but I'm going to put myself out there to say, I'm not sure that that's going to happen if we continue to see such spicy data out of the States. So what's the real conversation that we should be having as Albertans? We understand that rates are probably going to stay in that 4.5% to 5% range over the coming year. Probably in terms of a fixed rate mortgage, it's not a terrible time to be thinking about a 3 or a 5-year fix. They're very fair rates. Variable rates are still in that 6.2 to 6.4% range. Personally, I don't like paying a 1.5% interest premium for a variable rate mortgage because I honestly don't think that that will give me enough of an upside potential in the long run when I look out 2, 3, 4, 5 years. I actually don't mind that 3-year fixed rate right now. We're seeing that fixed rate right now somewhere between 5% and 5.5%, really depending on the lender, depending on this client situation, and depending on the down payment. When we see less than 20% down payment, that's when we see those lower rates. So overall, we are expecting that if you have less than 20% down payment, you can hope for that 5% range on that 3-year fixed mark, and probably somewhere between 5.25% to 5.5% on those 3-year fixed rates for a conventional mortgage. That means 20% down or more. Let's quit talking about rates and talk about what fundamentally matters way more than rates. It's supply. When I was looking at putting together this video, I went back through some old presentations and some old infographics that I've been sharing for a really long time. This is an infographic that I've been sharing that was put together by Ben Rabideau a number of years ago. So I've been sharing this kind of since the early 2020s. From the 1970s to the 2010s, we saw that on average, one new home was built for each 2.5 Canadians. In the 2010s, though, we really saw that differential get a little bit wider. There was only one new home built for every 4 Canadians. Overall, I think supply continues to be a huge problem. Let's look where that graph would be today based on new home starts, as well as the immigration numbers that we've been seeing for the last couple of years in Canada. This is another infographic from Ben Rabideau. In today's market, when you look at the immigration that we've had in Canada, we are seeing that there's only one new single family home being built for every 25 people that they added to the population last year. Yes, some of these people will rent. Yes, some of these people may want to buy a condo, but this supply crisis is real. So my question is, do you think the rates are more important, or do you think it is more important to understand that we have a massive supply crisis in Canada? A lot of people might argue that we have a lot of rental housing starts, that there's been an increased number of condo starts. Overall, we need to understand that in Canada, a lot of people want to own a single family home. We need to build those single family homes. And where can we afford to do that? These numbers are so powerful. When you look at home ownership as a percentage of median household income, it is still incredibly affordable to live in the major centers in Alberta. So this number is cresting out around 50% in Calgary and closer to 35% in Edmonton. It is incredibly affordable to live in these cities. I want to show you what it looks like for the graphs, these same graphs in Vancouver and in Toronto. Look at this graph for Vancouver. The average person cannot afford homeownership in Vancouver. That's what this is telling us, is that more than 100% of median household income would have to be spent in order to own a home in Vancouver. And Toronto is only slightly better. It's nearly 100%. So when we look at why people are moving to Alberta, it's because it is affordable. It is absolutely a great place to live, work, and raise a family because you can afford to do it. You can afford to buy a home, have some space, have a yard. So increasingly in this economy where we see people able to work from home, able to work remotely from Ontario while living in Edmonton, we are just seeing another increase of out-of-province people looking to purchase real estate in Alberta. So I talked a lot at the beginning of the video about rates, about what's going on in Canada versus what's going on in the States, about rate predictions, but I actually think fundamentally most of this is noise. What matters is that there aren't enough places to live in Canada, that Alberta is the most affordable place to live, and real estate is still accessible here. So my update right now is to say, we are keeping our eyes on all of the major communities in Alberta, Edmonton, Calgary, Red Deer, Lethbridge, even Medicine Hat. We are looking for opportunities. We believe wholeheartedly in the market. We believe strongly that if you are a young person or somebody else that wants to invest in real estate, either from a principal residence standpoint or an investment standpoint, this is a time to be looking at it. We'd love to help. Always feel free to reach out.